all of it takes us to our talk of the tape. Why some key market watchers say we're only in the middle innings of this resilient and relentless bull market. Let's ask Adam Parker what he thinks. He's the founder and CEO of Trivariate Research, a CNBC contributor. Welcome back.
Thanks.
Stop me if you've heard this before. Nvidia's up, and so is the S&P. It's almost like a daily occurrence now, right? The S&P is 5,100, 5,150. What's the next stop? Where are we going from here?
Obviously, what I'm going to say, it depends on the horizon and what you what you're planning for. If you look out 12, 18, 24 months, I think we got plenty upside. But, one thing I was thinking over the weekend is semiconductors are cyclical. Okay, they're cyclical industry, and maybe the amplitude and periodicity of the cycle is different this time, to bring out the physics terms, just because you have AI, and so there's sort of
they're not acting cyclical. Right?
But I know they are, and so I'm starting to get a little worried about just how big the movement's been and what's discounted for the next couple of quarters. Obviously, the holy grail would be if you could figure out how much these companies are over-earning and when they're going to tell you that they can meet demand, and 3 months before that, you probably want to get out for a downside move.
Yeah, this is somebody who used to make your living as a semiconductor analyst, so it's a space you have an eye on all the time because of what you used to do and what it still means to the market. Nvidia, I joke about it. It literally is up almost every day. AMD, new high today. You got Broadcom coming this week. Super Micro.
I don't know how to figure out what that's worth, but anything where they're mentioning AI-related terms on their website and their transcript seems to be up a lot, and we know those businesses are cyclical, and so I think that's the challenge. Is if you miss the whole first $2 trillion, it's today the day you walk in and buy it for the first time, and then you're worried you get it wrong in both directions. If you're looking out 12, 24, 36 months, then there's going to be more upside to the very early phases of the trend. I think your question about the broadening, though, is always a good one. I think you saw we wrote over the weekend. I don't think the Russell can outperform in a down tape. So if people are saying, well, I'm a little worried that we're going to get a pullback, then I don't think you go pile into the Russell for that trade just because it looks like it's cheaper on price to earnings. I think you have to believe they can outperform in an up tape. And if you are bullish and you think it's middle innings, then you're saying the gross margins for the average company are going to go up, and I want to own plenty of other things besides the Mag 7. And I think there's some intelligence to that view.
Well, I mean, even if you don't like the Russell and you say, well, a third of the companies in the Russell, they don't make any money. And then we have the regional banks to worry about and all that. Maybe don't use that as the tell of whether this market's broad, because it is probably the wrong place to look. I could tell you outside of tech, Disney, 52-week high. Darden, Lennar. I have a list. I don't know. There's like 100 stocks on my list, if not more. But I'm Darden, Lennar, Colgate, Costco, Marathon, Bank of America, BlackRock, JP Morgan. This is today, okay? Hitting new 52-week highs or all-time highs today. Danaher, Lilly, A.O. Smith, Copart, Cummins, Cat, Eaton. Don't tell me industrials aren't a good place to be. The manufacturing data is still kind of squirrely, and these stocks are going up.
We've said this a lot and written this a lot. I think it's lame to blame your, performance on the Mag 7 and say it's only been that. There's been tons of names that have gone up. That's a different question. The question about the Mag 7 is simply, can you afford to own zero or be equal weight when there's such a big piece of the S&P, and then you're having like a risk management issue. But there's been lots of alpha generative opportunities. We look at all the volatility we get on earnings. Like, it seems like every day there's Sweet Green's up 20 or something. There's plenty of stuff if you're a fundamental stock picker to pay attention to. I think what people don't really get is that there's so much money being run quantitatively with a 3-hour to 2-day investment horizon where they purposely don't trade around earnings. So it's the movement between earnings that's troubling people. Well, wait a minute, it worked on earnings and then it fades the next 10 days, or it kind of missed and then it rallies. Palo Alto missed and then it rallies the next 10 days. Like, there's a lot of stuff happening after earnings that I think is confounding people because the trading's not confirming the trend you heard on earnings. But I see a lot of dispersion.
All right, let me ask you this. I want to know if you agree with Tony Pasquarello of Goldman Sachs, whose latest note says the bullish thesis is clearly defined. We are perhaps in the middle innings of a major bull market. And even though he doesn't like the current location as a place to add incremental risk, right? I mean, he's alluding to the fact that we're up a lot. He goes on to say the recent wisdom of a secular bull is a reminder to keep your eye on the ball. right? He's not the only one talking that way these days. Do you agree? Bullish, clearly defined, middle innings of a major bull market. That makes sense?
Yeah, it could be early innings. I mean, I could see us, having a nice several-year run where earnings go up a lot over many years. I have never met him. I've seen his stuff on and off through the years, and I agree with it a very high percentage. I feel like I have a bit of a bromance with him, even though he doesn't know me. So maybe you can arrange a little coffee or wine between us. I think he makes a lot of sense. Look, I think my view has been the Fed's going to be accommodative but appropriately, that gross margins are likely to expand and earnings can grow for several years, and you should be bullish on U.S. equities. I will not tolerate two arguments. One, that bond yields will back up and break the financial system. If you get nervous about risk, bond yields will go lower. We've seen that every single cycle. And two, that you like non-U.S. equities more than U.S. equities. All the major trends, whether it's AI or software or life sciences, disproportionately accrue to the U.S. equities. And this whole thing where it's optically cheaper in Europe, I think is a joke. And you want to play that trade, good luck to you. But Europe is good for vacation and not for stocks. And it's always been the case.
All right, well, let's bring in Christina Hooper now of Invesco and Malcolm Ethridge of CIC Wealth. Malcolm's a CNBC contributor along with Adam, as we said. It's great to have you both with us. Christina, I'll turn to you first. Do you agree with Adam's assessment?
Yes, largely I do. I think what we're certainly seeing right now is the broadening of the market, and that's really critical for this rally to be sustainable. We are seeing greater small cap participation. We are seeing more cyclical participation. It's everything we wanted when everyone was so nervous that the market was so narrow and concentrated. So I certainly think this has legs. What's going to help it be the catalyst for continued rally? It's largely going to be about the Fed, I think. Now, the Fed has been driving markets for years now, really since the global financial crisis, in my opinion. It's had an outsized impact. Not the only factor, but certainly a big factor. And so I think what we're likely to see is a Fed that is arguably more accommodative than markets anticipate. We heard all the hawkish Fed speak. Raphael Bostic, they're all trying to talk down markets. And it's been a constant stream of very hawkish Fed speak for a while. They're trying to tamp down and a premature easing of financial conditions. But the reality is, I think they recognize that policy is very restrictive now. I think they're going to start cutting in May, and I think we're going to get more cuts than the market anticipates this year.
Malcolm, I almost feel like this bull market is like a good and deep and dominant football team that says, you want to play the game this way, we'll beat you that way. You want to play it the other way, we'll beat you there. You want a good ground game, you want to ground and pound, well, I'll stay in the mega caps. And when that stops working, well, okay, we'll throw the ball now. And we'll go to some of these other more broad plays in the market. And you know what? That's working too. So, this bull market is beating the bears by multiple ways, it seems, almost every day.
Yeah, you're basically describing Bill Belichick and the Patriots, that eventually their reign came to an end, right? Tom Brady moved on, so did the rest of the team other than Bill Belichick. And I think that's probably what we're setting ourselves up for here. I'm very concerned that the market and investors seem to be capitulating around the idea that a soft landing is all but guaranteed at this point. And we're basically talking about the magnificent one. Because if NVIDIA had disappointing earnings and the market went the other direction the following day, we wouldn't be talking about this broadening anymore. We'd have all piled back into the safe haven trade of mega cap tech, hid out there for a few months and called it a day. But because NVIDIA surprised us to the upside the way they did, it's lifting the entire semiconductor industry, AMD, Intel, Broadcom, all the others you had on the screen, in a way that doesn't really make sense. You can't describe it as anything other than FOMO, which reminds me of 2022 when, oh, by the way, Bitcoin was also trading in lockstep with the NASDAQ the way it is today.
I hear you, but, this is a far different market than we've been used to, Christina, right? Best sector over the last month, do you know what that is? Materials.
Yeah.
Okay? Industrials, financials. Tech isn't 1 or 2 or 3. Now, maybe 4. But this is a lot more broad than people are giving it credit for.
And what it's telling us is that the economy is going to reaccelerate, right? We tend to have that discounting of what's going to happen in the economy 6 to 9 months ahead. So my anticipation is that we see a landing. I wouldn't call it soft. I think it's going to be bumpy-ish, but I think it's going to be brief, and then we're going to have a reacceleration in the economy, and that's what the performance of the cyclicals, the materials, for example, is telling us right now.
Chris Harvey at Wells today says, repress your urge to go contrarian. It's like, okay, the mega caps may take a breather, but it's like Pasquarello says, keep your eye on the ball of what continues to work. When you think even that things are a little too stretched, maybe you're not keeping your eye on the ball enough. Yes, Alphabet's down year to date. Apple is not performing. Tesla is a loser of late. But you know what else is on my all-time high or 52-week high list? Meta, Amazon. So there are still, magnificent 4 or 5 or whatever stocks that are still working.
It doesn't sound like this group's exactly on the same page. I mean, Malcolm.
As you. Christina sounds kind of on the same page.
Malcolm thinks the economy is slowing a little, and I tend to agree with Christina that the equity market leads the GDP, not vice versa, and the equity market's telling you the economy is probably going to be fine 9 months from now. I think empirically that's true. As a Patriots fan, I wasn't sure if Malcolm was ripping on the Patriots in there at some point also, so maybe I was reading it with a sensitive lens. But
I'll buy you a coffee.
Yeah, I think as the worst team in the league this past year, but I think margins are likely going to expand. I think that's what I anchored to all the research we do on fundamentals is, can the gross margins expand for stocks? And if there's plenty of opportunities where I can see that. So that's kind of what I'm focused on. And I tend to think there's a lot of alpha generative opportunities. But I think it's going to be hard to sketch out more than 6-7% upside from here unless you really think that earnings are going to accelerate massively in 2025.
So you think Christina, you think the multiple of the market, which has expanded, obviously, can hold up, that it's not only justified where it is now. I've heard some people make the argument, well, I think the economy is going to do just fine, but the multiple of the market is going to have a correction.
So I think it can do just fine because we have to I'm assuming that the 10-year yield comes down. I think pressure comes off. I think that alters the PE multiple picture. And I would also say, so that to me says this is not irrational exuberance, it is rational exuberance. And I would also say that there will be a point when there are concerns about valuations, but there are opportunities outside the U.S. You can diversify a portfolio with European equities, which, by the way, even though you might be not thrilled with the economy in the Eurozone, it's all about positive surprise. And if we can get a little positive surprise, if we can get the ECB to start cutting a little sooner, that can be a nice catalyst for European stocks to go up, which, by the way, went up significantly last week.
Malcolm, why aren't you more positive on the market? I want you to explain your position. I mean, if you thought we were too concentrated perhaps before, and, it's NVIDIA's world and we're just living in it, well, this market seems to be telling a different story these days.
Yeah, I think the phrasing that you use, repressing the urge to go negative or go contrarian, is exactly how I feel right now. I am not saying by any means that anybody should be stepping out of this market because it can't go higher. We learned that lesson this time last year because in March of 2023, before ChatGPT came on the scene, you saw the estimates in the low single digits, mid single digits S&P targets for the year. And then all of a sudden, ChatGPT comes along, Microsoft gets set on fire, and so does the rest of the market. So I'm not necessarily saying we should all go negative on the markets. I am saying, though, we should be cautious, right? We still haven't seen the yield curve flatten. We know what that brings with it in historical terms, at least. We also still haven't seen the impact of higher for longer rates really take hold of the small caps. The S&P 600 and the Russell 2000 are up at a time where Raphael Bostic is telling us we're going to keep rates the way we are, and we may only get 2 cuts at some point this year. The reaction we've seen from markets is the opposite of what you would expect at a time when the Fed's not giving us what we wanted coming into the year where we expected to have cuts as early as March.
Yeah, I hear you, but I think what was is not what is. That the economy is strong enough right now and earnings have proven to be good enough that we don't need cuts as soon as maybe we thought we did a handful of months ago. That's a good enough insurance policy. And the bottom line is that we know what the Fed's next move is, and that's a cut, and that's all we need. How would you respond to that? Who cares when? Who cares how much? And who cares how many? We just know that the next one's lower. And that's what we're trading on now because we're anticipatory of all of that.
But I do think it matters when it is. I think we're looking over the fact that a lot of the smaller companies, you mentioned the number of them that aren't profitable in that smaller portion of the market, they need rates. Every quarter point raise matters to a company that small. And we're buying up the S&P 600 and the Russell as if rates don't matter. And I think that's a problem. That's where I expect that reversion back to mega caps to happen, is when the reality sets in that the only companies that can actually afford to fund their growth going forward are the ones that have these fortress balance sheets like an Amazon or a Microsoft or a Google or whoever. In the parade of small caps that has been happening, the broadening that we're talking about, finally starts to lose some steam because at some point reality has to set in. It just doesn't make logical sense.
All right, let's circle the wagons here. Like, what would make the market go lower? Okay, either China deteriorates massively and we get a demand problem that looks incremental, it hurts the materials, it hurts energy, it hurts industrials, it takes some air out of the tech trade. Two, the U.S. consumer collapses more than we think. Right? Everyone thinks it's kind of was in good shape, is eroding. We've seen some signs, Discover before the deal, other stuff that it was softening. So China, the consumer, or this quantitative tightening. Forget the front end that you're focused on. Let's focus on the balance sheet and the liquidity. Maybe that's the issue. I think those three things, if they get materially worse, could derail the market. Short of that, we're going higher. We're going higher because you're going to dream earnings are up next year versus this year. Margins are fine. And I totally think what Scott said is right, and it's been right for a year, which is there's an asymmetry that they're going to be more accommodative than not on the Fed. And all of us have learned, if we learned anything in the last 25 years, that we don't want to fight the Fed on the front end.
How do you think about that?
I agree. But I would say it's a very slim chance right now that we see anything dramatically bad happening. Let's take, for example, the consumer.
Some say that's a big risk in and of itself. The only risk out there seems that people are saying there are no risks.
Yeah, but you can't.
Well, you can have a bumpy landing, but you're not going to have the consumer fall apart. With low unemployment and with the fact that of the outstanding mortgages out there, 92% are fixed rate, and the average mortgage rate is 3.62%. So that tells us that the kind of pressures that Canadian consumers are feeling, that European households are feeling because of rate increases, aren't being felt. That transmission mechanism is not as strong.
Fixed.
Exactly. So fixed, we don't have the level of variable rate mortgages we had going into the global financial crisis. We learned, and we have that great luxury of having a 30-year fixed rate mortgage. That's a critical factor in terms of ensuring that there's a significant pool of healthy consumers. That plus a very low unemployment rate, even if it goes up 1 percentage point, I don't think it can trigger a recession.
So I agree that the consumer is likely to sort of slowly erode, not implode. The part that I don't know, I defer because I focus on U.S. equities, but I don't see how we get 2 cuts with unemployment this low that fast. So I think they're going to be a little less, accommodative than your forecast.
By the way, the ECB meets this week. Since we're talking about all of that, maybe they lead the central bank parade to the pool of cutting. I don't know.
Maybe it's Bank of Canada, which has been something of a first mover at times in recent years. But I think that the key, though, is that, as you said, Scott, we're moving in the right direction. We're going to get cuts, and I think it's going to happen sooner than we think.
What about, Bostic, Malcolm, talked about the risks of cutting too soon being you have the risk of, stimulating even further this euphoric behavior in the market. You look today, for example, Bitcoin, I think as I'm asking you this question, is up 6.5%, almost 7%. The biotechs continue to be bananas as a trade. I mean, there's some activity that leads some to believe we've got some overload of speculative action in the market, and we need to keep our eye on that very closely, not to mention some of the higher growth, higher multiple AI-related plays that have gone crazy, too.
Irrational exuberance, Scott. So Christina's last point about not necessarily seeing any meaningful risks out there is exactly what makes me cautious, right? It's the age-old lesson from the Berkshire camp to be greedy when others are fearful and fearful when others are greedy. When we start talking about there's really nothing out there that we see as a risk to this particular bull market, that's when my antenna goes up and I start to worry. I just start to worry about where we are. And also, you've used the word accommodative a few times, but I'm not so convinced that this Fed is talking about being accommodative. They're talking about pushing out the rate hikes that we started this year, saying, will they come at the front end of the year? Will they come in the second quarter? And those were the only two questions anyone was willing to entertain, the bond market included.
I understand, but you're suggesting that you can't be real bullish the market until the Fed actually cuts. But the market, as we always say, the train leaves the station long before that. And by the way, it's already left. It depends on how far down the tracks you want to let it go. That's the biggest risk at this point.
I think the point that I'm making is that we may have already gotten the bull market, that rush that we're all talking about and we're all anticipating. We're up 7% so far to start this year, and we're not even through Q1. We may have already gotten that bull market rush that we're all talking about may be coming. Mm-hmm. That's the part that I'm concerned about.
I would just say, look at Jim Bullard's comments. He's the one person who's no longer part of the Fed, so he doesn't have that vested interest in tamping down financial conditions. 2 weeks ago, he said the Fed should start cutting now.
I meet with institutional investors every day, all day. Lots of them have lots of concerns. I don't agree with Malcolm with your statement that nobody's saying there's anything to worry about. I think people are worried about all the things I listed, the consumer. They're worried about commercial real estate. They're worried about China. They're worried about the balance sheet and liquidity. So I don't see it as being fearful when others are greedy. The market's risk on and speculative, but I think people are fearful and worried, and they're trying to figure out, do I rotate to the 2-year or do I get more defensive within the U.S. equities? But they're not whistling, I would say.
If anything, markets have been climbing a wall of worry for months.
All right. Well, we're going to keep following it and keep having these conversations. Malcolm, thank you. Christine,
good to see you guys.
Parker,
thank you.
Good to have you back here, Post 9.